Three different 70-year-old men walk into their banks on the same Tuesday morning in March. First guy wants to move $50,000 from his savings account into physical gold. Teller says there's a 2-week wait on American Gold Eagles. He asks why. She shrugs. Second guy calls his broker at Fidelity, asks about buying gold mining stocks. Broker says, sure, but mentions the premiums on actual gold coins are up 17% from last month. Guy doesn't know what that means. Third guy does nothing, watches the news, sees gold hit $4,000 an ounce, thinks it's too expensive now, decides to wait for a dip. 6 months later, 2 of these men still have their purchasing power, 1 doesn't. The question isn't which strategy was right. The question is, why are premiums spiking? Why are mints running low on inventory? And why is nobody talking about the fact that central banks just bought 220 tons of physical gold in a single quarter? Here's what I'm going to walk you through. Why this moment is different from every other gold rally you've ignored for the past 20 years. The actual mechanics of how the global reserve currency system is breaking down in real time, not in theory. And the specific psychological trap that's going to make 90% of retirees miss this completely until it's too late. I've spent the last 3 weeks reading central bank balance sheets and commodities market data that would put you to sleep faster than Ambien. And what I found should genuinely concern you if you have more than $100,000 sitting in dollar-denominated assets right now. The central metaphor for what's happening is this. Imagine the global financial system as a game of musical chairs. For 75 years, there have been 100 players and 100 chairs. Everyone's comfortable. Then the music stops and someone counts the chairs. Turns out there are only 97 actual chairs and 300 claims to those chairs. The scramble hasn't started yet because most players haven't looked down, but the ones who have, they're quietly standing next to their chairs with their hand on the backrest. That's what central banks are doing with physical gold right now. They're putting their hand on the backrest while everyone else is still dancing. Let me show you how we got here. After World War II, the United States held about 70% of the world's monetary gold. Every other country's currency was pegged to the dollar, and the dollar was pegged to gold at $35 an ounce. You could theoretically walk into the treasury with a $100 bill and get 2.8 ounces of gold. This was the Bretton Woods system. It worked great until it didn't. By the late 1960s, the US was printing dollars to fund the Vietnam War and domestic spending programs faster than it was accumulating gold. Other countries noticed. France, under Charles de Gaulle, literally sent a warship to New York Harbor to pick up their gold. Not a request, a warship. They wanted the actual metal, not paper promises. In August of 1971, President Nixon went on TV on a Sunday night and said, "We're closing the gold window. No more redemptions." The dollar became a pure fiat currency backed by nothing except the full faith and credit of the United States government. And here's the interesting part. Most people think that was the end of the story. It wasn't. It was the beginning. Gold went from $35 an ounce to $850 by January of 1980. That's a 24x return in less than a decade. People who own gold preserved their wealth. People who didn't got destroyed by inflation that hit 14%. Now, here's where the psychology gets interesting. Most retirees right now are operating under a framework that was true, but is no longer true. The framework is this: dollars are safe, gold is risky. That was a reasonable belief from 1985 to 2015 when the dollar was strong, inflation was low, and US hegemony was unquestioned. But the world has changed, and the framework hasn't updated. This is the same cognitive trap that killed Blockbuster. Their framework was people rent movies at stores. That was true until it wasn't. By the time they updated their framework, Netflix owned the game. Here's escalation number 1. The dollar's role as the world's reserve currency isn't a law of nature. It's a network effect based on trust and utility. Countries hold dollars because other countries hold dollars because everyone prices commodities in dollars. But network effects can flip fast. Look at social media. MySpace had everyone until it had no one. The tipping point wasn't obvious until it had already tipped. The dollar is showing the same early warning signs. When Russia invaded Ukraine in February of 2022, the West froze $300 billion of Russian central bank reserves. Whether you think that was morally justified is irrelevant to this analysis. What matters is every other country on Earth watched that happen and realized if we piss off Washington, they can freeze our reserves too. That's not a reserve currency. That's a political weapon. China watched, Saudi Arabia watched, India watched, Brazil watched. They all came to the same conclusion. Holding dollars is a sovereignty risk. So what's the alternative? You can't freeze gold that's sitting in your vault in Beijing or New Delhi. You can't sanction a bar of gold. And you can't print more of it with a keystroke. This is why the People's Bank of China has been buying gold every single month for the past 2 years. They're not doing this because they think it's a good investment. They're doing this because they're building a parallel system. And when that system is ready, the music stops. Now you might be thinking, okay, but central banks are slow-moving bureaucracies. This will take decades to play out. That's where you'd be wrong, and here's why. The pace of central bank gold purchases has accelerated dramatically. In the third quarter alone, central banks bought 220 tons of gold. That's a 28% increase from the previous quarter. We're not talking about slow diversification. We're talking about aggressive accumulation. And it's not just China. Poland's been buying, Singapore's been buying, Turkey's been buying. Even countries that have historically been staunch US allies are quietly moving reserves out of dollars and into gold. Let me tell you a story about incentives. In 2008, I was sitting in a meeting with my accountant and a tax attorney. We were restructuring my business. The attorney said something I'll never forget. He said, "Mark, when you're trying to predict what someone will do, ignore what they say and look at what they're incentivized to do. Words lie. Incentives don't. That lesson applies here. Central banks are incentivized to maintain stability and preserve purchasing power. If they see the dollar system cracking, they're incentivized to diversify before everyone else does. That's exactly what's happening. They're not announcing it on CNBC. They're just quietly buying gold every month and hoping you don't notice until they're positioned. Here's the kicker for this section. While central banks are buying physical gold, the paper gold market operates on a fractional reserve system. The COMEX, the major futures exchange where gold gets traded, has about 100 claims on paper for every ounce of physical gold in their vaults. Some estimates say it's even higher. Think about what that means. If even 10% of people holding paper gold contracts demand physical delivery, the system breaks. There's not enough gold. The price would have to rise dramatically to clear the market. This isn't conspiracy theory. This is just how fractional reserve systems work. And they work great until everyone wants their gold at the same time. Now let's talk about what this looks like in practice with real numbers. Let's say you're a 55-year-old guy with $800,000 in your 401k. You've been saving for 30 years. You're 10 years from retirement. Your portfolio is 70% S&P 500 index funds, 20% bonds, 10% cash. That's the standard allocation financial advisors recommend. Very reasonable. Here's the problem. All three of those assets are dollar denominated. If the dollar loses purchasing power, your entire portfolio loses purchasing power in lockstep. You're not diversified. You have three different forms of the same bet. Let's run the math. If inflation runs at 6% for the next 10 years, which is not crazy given where we are, your $800,000 will have the purchasing power of about $440,000 in today's money. You'll have the same number on your account statement, but it'll buy half as much. That's a 55% wealth destruction event that happens slowly enough that most people don't notice until they're in retirement and wondering why their budget doesn't work anymore. Now, if you had moved 10% of that portfolio into gold back when gold was at $2,000 an ounce and gold goes to $8,000 an ounce over the same period, which is plausible given the historical precedent, that 10% allocation becomes a 25% allocation and offsets a lot of that purchasing power loss. But here's what actually happens psychologically. When gold is at $2,000, it feels expensive because it was at $1,200 5 years earlier. So you don't buy. When gold is at $4,000, it feels even more expensive. So you still don't buy. You're waiting for a pullback. Meanwhile, the entire premise has changed. Gold isn't expensive. The dollar is weak. You're using the wrong unit of account. This is the cognitive trap. You're measuring gold in dollars, while dollars are losing credibility as a measuring stick. Here's the second escalation. The petrodollar system is unwinding. Since the 1970s, Saudi Arabia and OPEC have priced oil exclusively in dollars. This created artificial demand for dollars because every country that wanted to buy oil needed to hold dollars. It was a brilliant system for the United States. We could print dollars and the world had to accept them because they needed them for energy. That deal is breaking down right now. Saudi Arabia announced they're accepting payment for oil in yuan, in rupees, in other currencies. This isn't some fringe news. This was reported in mainstream financial publications. The monopoly is over. When the petrodollar dies, and it is dying, the amount of dollars the world needs to hold drops significantly. Supply and demand says if demand drops and supply stays the same, price falls. For a currency, falling price means inflation. Your dollars buy less. And here's a thing that should genuinely scare you. The U.S. Government is currently running deficits of about $2 trillion a year. We're adding that much debt annually. Who's buying that debt? Not foreign central banks anymore. They're reducing their treasury holdings. The Federal Reserve has been buying it by printing new dollars. That's the definition of monetizing debt. And historically, every country that has monetized debt at this scale has experienced significant inflation or currency collapse. Now, to be fair, the US is not Zimbabwe. We have the largest economy, the strongest military, and the most liquid financial markets. That buys us time, but it doesn't buy us immunity from math, and the math is bad. The Congressional Budget Office projects that by 2030, interest payments on the national debt will exceed defense spending. We'll be spending more money just servicing the debt than we spend on the military. That's not sustainable. And the only way out is either default, which is politically unthinkable, or inflate the debt away by printing more dollars and letting inflation reduce the real value of what we owe. Let me give you the second comedic cutaway. There's a scene I imagine happening in a Federal Reserve meeting. One guy says, we have two options. Option one, we raise rates high enough to actually kill inflation, which will crash the economy and trigger a financial crisis. Option two, we keep rates lower than inflation, which slowly destroys the currency, but keeps the system stable for a few more years. Another guy says, what if we just say we're doing option one, but actually do option two? First guy says, that's called credibility management. We've been doing that for 3 years. Here's the third escalation. The physical gold market is showing signs of stress. Premiums are rising. That means when you go to buy a gold coin or a gold bar, you're paying more above the spot price than you used to. Why? Because there's not enough physical gold to meet demand. Mints are struggling to keep up. Dealers are running low on inventory. I called a dealer 2 weeks ago to check on American gold eagles. He said there's a 3-week wait. I asked why. He said everyone's buying. When I asked who, he said it's not retail, it's institutions and family offices. The big money is already moving. Retail hasn't caught on yet. This is the same pattern you see in every asset before it goes parabolic. The smart money moves first quietly and slowly. Then the institutional money moves. Then the retail money moves. By the time your neighbor is talking about it at a barbecue, the easy gains are gone. We're in the institutional phase right now. Central banks, sovereign wealth funds, family offices managing 9 figures or more, they're buying physical gold. Retail is still sitting on the sidelines, thinking it's too expensive. Here's a data point that should get your attention. In 2020, during the COVID panic, premiums on gold coins spiked to 20% over spot. People wanted physical metal, and there wasn't enough. The paper price was saying gold should be $1,800 an ounce. But if you actually wanted a coin in your hand, you were paying $2,100. That's a market dislocating in real time. Imagine what happens if we get a real crisis, a major bank failure, a sovereign debt default, a geopolitical event that spooks markets. The premium on physical gold could hit 50% or more. The paper price could say $5,000, but good luck buying a coin for less than $7,500. And here's where the incentive structure gets really interesting. The people who run the paper gold markets, the big banks and trading firms, are incentivized to keep the paper price low. Why? Because they're short. They've sold more gold than they actually have. If the price spikes, they lose money. So they have an active interest in suppressing the paper price through futures market manipulation. I'm not saying this to sound conspiratorial. I'm saying this because it's documented. Banks have been fined multiple times for manipulating gold prices. It's not a theory, it's case law. But here's the thing about manipulation. It works until it doesn't. You can hold a beach ball underwater, but only for so long. Eventually, the pressure gets too great and it shoots up. That's what happens when the paper market loses credibility and people demand physical delivery. The manipulators lose control. The price discovers its real level based on physical supply and demand. And that level is significantly higher than where we are now. Here's the fourth and final escalation. The geopolitical landscape is more unstable than it's been since the Cold War. We've got a hot war in Ukraine. We've got escalating tensions between the US and China over Taiwan. We've got conflicts in the Middle East. We've got food shortages. We've got energy crises. We've got political polarization within countries. All of these factors create uncertainty, and uncertainty drives demand for safe haven assets. Gold is the ultimate safe haven. It's been money for 5,000 years. It has no counterparty risk. It doesn't care who wins the election. It doesn't care about geopolitics. It just sits there and holds value. Think about it from the perspective of a wealthy individual or a family office managing serious money. Where do you park your wealth when you don't trust the government, you don't trust the banks, you don't trust the stock market, and you don't trust other currencies? You buy hard assets. Gold, real estate, art, collectibles, things that have intrinsic value and can't be printed. The ultra-wealthy have been doing this for decades. They understand that wealth preservation is more important than wealth growth once you have enough. The middle class has been told to put everything in index funds and trust the system. And when the system breaks, the wealth gap explodes. The people with hard assets survive. The people without them get wiped out. Let me tell you one more story to make this concrete. I have a friend who runs a hedge fund. Smart guy, Ivy League education, 20 years in finance. We were having dinner about 6 months ago, and I asked him what he's personally doing with his money, not the fund's money, his personal wealth. He said he's been moving 20% of his liquid net worth into physical gold and storing it in a private vault in Switzerland. I asked why Switzerland. He said because it's outside the US. Banking system, outside the reach of potential capital controls. And Switzerland has a long history of respecting property rights. Then he said something that stuck with me. He said, "Mark, I hope I'm wrong. I hope this is all wasted insurance. But if I'm right, this 20% will be worth more than everything else combined." That's the mentality you need to understand. The people who have access to information you and I don't see, the people who sit on corporate boards, who talk to central bankers, who have relationships with policymakers, they're not panicking, but they're quietly protecting themselves. They see the same data I'm showing you, they just have the resources to act on it more aggressively. Here's the kicker for this entire section. The final warning isn't coming from me, it's coming from the market. Gold at $4,000 an ounce is the market screaming that something is broken. The smart money doesn't buy gold at all-time highs because they think it's going to double next month. They buy it because they think the alternative, holding dollars, is a worse bet. That's the signal. And if you're not paying attention to that signal, you're going to be the one standing when the music stops with no chair. Now you're asking yourself, okay, what do I actually do about this? Here's the honest answer. I don't know your situation. I don't know your risk tolerance. I don't know your time horizon. I'm not a financial advisor and this isn't financial advice, but I can tell you what I'm doing and why. I have multiple six figures invested in markets. About 15% of my liquid net worth is in physical gold, not paper gold, not a gold ETF, physical gold, coins and bars in my possession. Why 15%? Because that's enough to matter if the system breaks, but not so much that I'm betting everything on one outcome. Here are 3 practical takeaways that aren't generic nonsense. First, if you have more than $200,000 in retirement accounts and 0 exposure to gold, you're taking a massive uncompensated risk. You're betting your entire future on the dollar remaining stable. That's not diversification. That's concentration risk with extra steps. At a minimum, consider moving 5 to 10% into some form of gold exposure. Physical is best. A gold ETF is second best. Gold mining stocks are third best, but much more volatile. Second, understand the difference between insurance and investment. Gold is insurance. It's not supposed to make you rich. It's supposed to keep you from becoming poor when everything else falls apart. If gold sits at $4,000 for the next 10 years and does nothing, but your stocks and real estate go up, great. The insurance wasn't needed. But if the dollar collapses and gold goes to $15,000, that insurance just saved your retirement. You're paying a premium in the form of opportunity cost for downside protection. That's a rational trade if you believe the risks are real. Third, if you decide to buy physical gold, do it through a reputable dealer. Check reviews. Verify they're an authorized distributor. Expect to pay a premium over spot price of 5 to 10%. That's normal. Anything higher and you're getting ripped off, store it securely. If you have a significant amount, consider a private vault service rather than a home safe. A home safe can be found in a break-in. A private vault is off the grid and insured. Now, the cynical reality that nobody wants to hear. Most people watching this will do nothing. They'll nod along. They'll think it makes sense. And then they'll go back to their lives and assume someone else will fix this. That's human nature. The pain of action feels greater than the pain of inaction, even when inaction has worse long-term consequences. This is why what 99% of people do is usually what not to do. The crowd is always wrong at inflection points, because inflection points require you to update your framework before the new reality is obvious. And most people can't do that. They wait for confirmation. By the time the confirmation comes, the opportunity is gone. So here's the final thought. The financial system you grew up trusting is not the same system we have today. The rules have changed. The incentives have changed. The risks have changed. And the people who understand this are already positioned. The question isn't whether you believe me. The question is whether you believe the central banks who are buying 220 tons of gold per quarter, whether you believe the Saudis who are accepting non-dollar payments for oil, whether you believe the premium spikes and delivery delays in the physical gold market. Those are facts, not opinions. And facts don't care about your framework. You either update your framework to match reality, or reality updates your net worth for you.